Hello, I'm Tony Wickenden of Technical Connection, and it's that time of year again, isn't it? The closing of one tax year and the starting of another. And the closing of the 25-26 tax year and the beginning of the 26-27 tax year offers a particularly good opportunity for you to engage with your clients. Why? Well, because we've experienced so much tax change in the past two budgets leading up to the end of this tax year, many of which those changes are in place now. And of course, we're entering into a year where we know we are going to see the implementation of other tax changes. We're in a tax planning sweet spot just after the 31st of January, when many of us would have experienced the pain of paying tax and completing and maybe sending in at the very last minute our tax return, and the 5th of April, the ending of this tax year. A great time to talk to individuals around tax and tax planning because it's fresh on their mind. So much of the engagement at this time of year is about, and it's understandable, tax year end planning, not missing those last minute opportunities. However, it's also, I think, and perhaps even more than tax year end planning, a really important time to set the scene for next tax year, to have a really good 26, 27. So much of the activity around the end of the tax year is around stuff that you probably should have done earlier in the tax year but didn't get round to it. So why not remove that regret risk of taking this last minute action by planning in advance? There are, of course, those last minute opportunities which we must pay attention to. Maximising pension contributions, ISA contributions, using your inheritance tax annual exemptions. This year, of course, there is the reduction, we know it's happening, of the VCT front-end income tax relief from 30% to 20%, taking effect from the 6th of April 2026, the start of the next tax year. This is the last tax year that you can get 30% relief in your front-end VCT investments. That's definitely a discussion that you should have with clients for whom that might be appropriate. Company dividends, the tax rate on dividends is changing. It's going up for basic and higher rate taxpayers from the 6th of April next year. Having those corporate profit distribution discussions really important, perhaps even more important than it has been in past years because of that known increase to the rate of taxation applicable to basic and high rate taxpayers taking effect from the 6th of April. And of course, that all important consideration at least of using your CGT exemption is a use it or lose it exemption. I know it's only at £3,000, but it's £3,000 and used properly can ensure that you have either a tax-free realisation of proceeds or done the right way, not triggering the anti-avoidance bed and breakfast provisions, that you make a disposal and a reacquisition either outside the 30-day period or reacquiring different but similar assets so that you raise the base value of your investments and minimize the chargeable gain when you finally encash. And to that point I made earlier, having a good discussion now about setting your stall straight for the future tax year, then consider this. There's very little that you can do at the end of the tax year to use your income tax exemptions. Your personal allowance and your lower tax rates and your dividend allowance. But there's plenty you can do at the beginning of the tax year. Of course, the exception to that dividend point is the one I mentioned, where you control the income because you own the company. But setting a good platform for making the most of your tax allowances and exemptions for the year is clearly best done at the beginning of the year. Consider investment income optimization. We have got those known changes to dividend taxation for higher and basic rate taxpayers. We know we have the year after that an increase, a 2% increase to the rates of tax on savings income, and that's for all taxpayers, not just basic and higher rate taxpayers. It includes additional rates taxpayers who are excluded from those dividend tax rate changes. We have a 2% increase to the rate of tax on savings income and on income from property from 2027. Consider how you can shelter your client from those tax increases, shelter them from the dividend tax increases happening from the 6th of April. ISAs, pensions, obvious examples, but how about the tax deferment power of investment bonds, onshore or offshore, dependent on the circumstances? It's a good time to reassess IHT planning, and I'll look at that in a minute, especially since, of course, we have the very soon to be implemented inclusion of unused pension benefits into your estate on death. Think about regular investment. So many people that I speak to, and I include myself in that, get some anxiety around making that last minute investment to use your ISA allowance, for example, at the end of the tax year, because was this a good time? Trying to time the market. Of course, we all know it's about time in the market rather than timing the market. You can take away that anxiety if you invest regularly throughout the year to fully use your allowance for that year, an ISA being the most obvious example from that, rather than the last minute 20 grand investment. Invest throughout the year, get the benefit of pound cost averaging and take away the anxiety. Then you've got your normal expenditure pattern that you can set going, and it has to be set going. The earlier you set that going, the more you get used to it, the more it's likely to qualify as normal expenditure out of income. I'll say a little bit more about that in a minute. And then, of course, consider beyond no-brainer tax-efficient investments, investment bonds, collected with the right underlying portfolio complexion, effectively. Certainly, of course, ISAs and pensions. And then possibly VCT investments. Don't forget VCT investments. Okay, we are seeing a reduction of that initial income tax incentive from 30 to 20, but we're still keeping tax-free dividends. Most of what I've talked about so far could be applicable to any taxpayer. However, if you have a business owning client, then there are a number of specific aspects of tax and tax planning at this time of the year and looking forward to the next tax year that you should consider having a discussion about. All of the opportunities for engagement with business clients that are referenced on this slide are covered in more detail in the financial planner guide that's made available to you by Wealth Time. But in particular, you should think about at this time of year the extraction strategies for your corporate business owning clients in light of that 2% increase to dividend taxation. I referenced that earlier in this video. The rates going up for basic and high rate taxpayers from the 6th of April. So think about dividend declaration before that date. We've got those business property relief and agricultural property relief limitations coming in from the 6th of April 2026. They're almost upon us. We've been talking and thinking about them for a while, but they are almost upon us. So having an inheritance tax-based discussion with your clients is definitely worthwhile now. For those that will be affected, remember, we do have that gift effectively of the raising of the limit for 100% relief from 1 million as it was originally proposed to 2.5 million. That also kicks in, of course, it's relevant from the 6th of April 2026. The announcement was made just before Christmas. Inheritance tax and estate planning is probably the last item on your tax year end, tax year start to-do list, but it's an item that should definitely not be forgotten. I've already mentioned, but I'm going to mention it again, that £3,000 annual exemption. Make sure you at least consider using that. It can be carried forward 1 year, but 1 year only. Make sure you consider carefully thinking about the normal expenditure exemption, the power of using it over a number of years, because that's what's necessary in most cases to qualify for the normal expenditure exemption. So why in this year, at this time, particularly reassess inheritance tax planning? Well, we have that freeze on the nil rate band and the residence nil rate band that is now going on until April 2031. We have the business property relief and agricultural property relief limitations applying from the 6th of April. That 100% relief on qualifying property applying for assets up to £2.5 million, 50% relief thereafter. That's not bad. It's not as good as it was though. And we have 50% relief from the start on effectively AIM stock. That's happening from the 6th of April. So for those clients for whom that's relevant, you should be having that discussion too. And of course, we are entering into the last year before those pension changes are implemented, those 2027 pension changes that bring unused pensions into the estate of members. We know most members, most people won't have any pensions left when they get to death, but many of your clients will. So that discussion should definitely be had. And some of those will be taking out cash as a result of that change, where they were thinking of the pension as more as an estate planning tool, as one that was going to generate income for their retirement because they had other assets, perhaps. That cash may have been removed, particularly the tax-free cash, because they thought no point leaving it in there. It's not going to be inheritance tax-free. And if they die after 75, it's also subject to income tax. So there may be more people with more cash, but with still that aspiration to do the best thing by their family and minimize inheritance tax. So to consider going forward the ways in which you can put that money in an inheritance tax effective zone, because it would have been removed from an inheritance tax effective zone that will soon no longer be one. And remember, it will remain inheritance tax effective, the pension that is, up until April 2027. Just a point to remember. But if people do have cash to invest, then you have the full range of DGTs, loan trusts, discretionary trusts available to you. Outright gifts can also be made with that cash. Don't forget your business relief strategies. Oh, relief is only at 50% for AIM shares and only at 50% above 2.5 million. But 50% relief is much better than no relief, isn't it? And 2.5 million is quite a big number. Annuities might be worth considering as a place to place that cash. Buying an annuity and replacing the cash that you've spent on the annuity, which won't be included in your estate on death, by the way, of course, because the annuity dies with you. Then you've got the possibility, subject to associated operations provision and having proper underwriting, the fact about having a life insurance plan to replace the money that you've spent on the annuity, but replace it completely free of inheritance tax, because of course the policy is going to be in trust. Outright gifts using the normal expenditure exemption, maybe as regular payment, not maybe, definitely as regular payments made, even if the payments come from the pension fund, even if they partly come from tax-free cash, they are going to qualify as normal expenditure if they satisfy all the other tests for the normal expenditure exemption. And let's not forget, please let's not forget the power of life insurance. Life insurance in trust to provide the money in the right hands at the right time, completely free of inheritance tax. So I'm going to leave you with some key takeaways illustrated here on this slide. Essentially, have the right conversations with the right clients at the right time. And that right time is right now.